Good afternoon, and thank you for joining us for another educational webinar within our series that we've hosted now for close to 6 months. So I'm very excited to be presenting today on Comprehensive Credit Reporting 101. And I am joined by James O'Connell from Equifax. Just a bit of housekeeping. So if you do have any questions, please know that you can ask questions in the Q&A function, and we do have senior credit in there today who are fielding those questions. So please utilize that chat option because then we'll be able to get back to you straight away with any policy questions or scenarios that you might have. And then also at the end of today's session, like normal, we have got a survey that is going to come to you after you close out of the webinar. Now, it does have 7 questions in there, all around supporting you and your business objectives. If you do have a scenario or you're looking for further training, you can note that or tick yes to that question, and then we can have your BDM or your RM reach out to you within the next 24 hours to lock in that meeting with you and or to discuss a scenario. So please do complete the survey. It really does assist us in being able to better support you moving forward. There's also a new question there as well around additional topics for education. So I have highlighted quite a few topics in there that you can select what's important to you in terms of what you want to see. And there's also an option in there as other. So if you do have a topic that's not listed on there that you really want to know about, please tick that box, because then your BDM or RM can contact you, understand what that is, and then we can factor that into upcoming webinars just to make sure we are providing you with that education that you need. Now, my name, as you know, is Samantha Hanson. I'm the National Manager here at Pepper Money for Sales and Broker Support. And I'll throw to James to give a bit of an intro into who he is and what he does.
Thanks, Samantha. So yeah, James O'Connell, Consumer Risk Specialist at Equifax. So my job is really specialising in conversations around consumer credit risk, credit reports, credit scores, etc. And I support our account management team in their conversations with, lenders and how they use our products, or, brokers and aggregator groups.
Perfect. So you're the expert on comprehensive credit reporting. Excellent. We've got the right person here today. All right. So let's get cracking. Okay, so I think obviously today's session really does highlight the Pepper Money world and us being able to facilitate and provide solutions in that non-bank lending space, particularly around clients who have been through a life event in the past. So as you can see, we have got a very diverse product offering across our products in terms of your prime, near prime, clear, near prime and specialist. And you look at that in comparison to what your major banks are offering you these days, which is obviously that prime type of client. Now, in terms of our lending breadth and policy depth, so as you can see, we offer home loans, commercial loans, SMSF and construction. We do also offer personal loans. We will have a webinar on personal loans coming up next month, so be sure to look out for the invite for that one. But when I first started at Pepper, close to 6 years ago now, we really did only have the residential products, and that was a prime, near prime and specialist. So now we've obviously built that out to include near prime clear in that residential home loan offering. And now we also have the home loans, now we also have the commercial loans and SMSF and construction, and all of those have that prime and near prime cascading credit model attached to that as well. So really exciting. We're always trying to diversify and increase our lending breadth and policy depth to better service you and your clients. So there's a massive opportunity here for credit education. So as you can see, only there's 38% of Australians who have never checked their credit report before, and I do know that we do often see a lot of applications that come in where the broker has actually not run a comprehensive credit report or an Equifax on the client, and sometimes that can result in not a very good customer experience, because the loan has been submitted with a sort of a prime rate in mind, and then obviously the result of them having some adverse impacts on the credit report obviously would not sit them in that prime solution anymore. So obviously James is going to run us through all those benefits. So it's a great segue into his piece today. And he's going to take us through the access seeker report and also comprehensive credit reporting. Over to you.
Great, thanks, Samantha. So yeah, so what is the concept of an access seeker report? Because you may have heard that term, bandied around, but it's actually defined in the Australian Privacy Act. So a broker, potentially a credit repairer, a debt consolidator, etc., are all defined as an access seeker. And essentially what that means is you can access someone's credit report as long as you're acting on their behalf and you're helping them to deal with credit reporting body, such as Equifax, or more importantly, a credit provider in your case. So Pepper Money or any other lenders that you may be dealing with. So it gives you full access to the credit report, the credit score, all the comprehensive information, including any accounts they've got, any repayment history, and hardship information, etc. And the important thing here is it doesn't impact their credit score. So accessing it as an access seeker means that you leave what's called a file access. So the individual can see that if they get their own credit report, but it's not visible to other lenders. So you may also hear the term soft inquiry in the market. It's essentially the same thing as a file access.
Okay, great.
So why run an access seeker report? So, I mean, there's multiple reasons. One would be around ID verification, just getting to know your customer. Obviously, you'll go through, collect their ID details, get consent, and then once you run a search on the Equifax Bureau, you'll know that you've got, a match to someone, they've got a credit file, etc. So it's an important part of the process. Also, can they afford the loan? So you've probably collected some sort of income data on them as well. So the Equifax report will then show, things like credit liabilities, what accounts they've got, what credit limits, etc., which will, form part of the picture around if they can afford the mortgage or whatever, credit product you're putting in front of them or they're applying for. And yeah, more importantly, just their overall credit history. So do they have defaults? Do they have missed repayments? Or are they a good customer, and where do you sort of fit that customer into the lenders that you're looking at submitting these applications to?
Yeah, so I think it really does just gives that a great snapshot of that client, their character, their willingness to repay, all those types of things.
That's right. Yeah, and so some of the benefits for you as a broker running these sort of reports, so you're delivering a lot more value to your clients. You're sort of seen more as that trusted advisor, educating them on their credit report and their credit score and, the reasons why they should care about it. It'll help you get quicker decisions with lenders, improved outcomes and potentially, improved approval rates with lenders. Also helps with any responsible lending obligations, so making sure that this, customer is best fit for the lender that you're looking at putting them through to. And probably one of the most important ones we hear, and probably you hear as well, is reworking applications. So, lender gets an application through, it's not complete. Yeah, they haven't disclosed all liabilities. So this will just make sure that the application is complete and the lenders, are hopefully able to, submit that deal through without sort of going back to you as a broker and asking for further information.
Yeah, beautiful. Yeah, so to my point earlier, we do see a lot of applications where there hasn't been an access seeker completed. So big time saver.
Exactly. Yeah. So moving on to the types of credit scores that we've got in market, and this is important because, some people might think we've just got one credit score, but over the years, the market's evolved, Equifax has evolved, we've created new scores. And it's hard to just remove one from market, right? So lenders might use different types of scores depending, where they're at and what their sort of conditions are. But essentially, there's two comprehensive scores. So our latest score is Equifax One score, which we'll cover on the next slide. And the other score is Equifax Apply Comprehensive. So they're both comprehensive scores. Many lenders in market are using those. But there are a couple of negative scores. So some lenders haven't actually moved to the comprehensive credit reporting regime. So it's just important for you as a broker, if you are dealing with other lenders, that you know what score they're actually utilising. So, and there's two scores there. So Equifax Apply Negative and Vita Score 1.1, which is sort of a legacy score, but some lenders are still utilising that. So also more important to know is all the scores are on the same scale. So they're all from -200 to 1200. And each 100 points that score goes up or down, essentially, halves or doubles their risk of adverse. So no matter what score you're looking at, they're on the same scale, but an individual might have a different one score than they do to their negative score, because it's looking at different information on the credit file, for example.
Okay.
So that's where you run a report, you'll see, potentially 3 scores that are returned there. So it's important to know, if Pepper is using 1 score, for example, that you're also looking at 1 score when you're looking at submitting that deal through to Pepper.
Yeah. Okay. So as you've mentioned, obviously not all lenders are utilising the comprehensive credit reporting. I'm aware that there are some lenders that aren't using it. When was comprehensive credit reporting introduced?
Yeah, so it was introduced in 2014, which was a change to the Privacy Act. Although it sort of, lingered around for a while, there wasn't a lot of traction. Probably around, I think it was 2020, there was a mandatory, bill introduced, which said, that at least the major lenders, need to participate. And then I think around 2022 was when they needed to comply with that. So we've really seen a big, build up of data over that last few years, to a point where we're probably at like 90 to 95% coverage of accounts in comprehensive credit reporting. And so that covers the big 4, top 10, most second tier lenders, etc. But you still do have, some third tier lenders and other more niche lenders that are probably still in that negative only environment.
Yeah. Perfect. Equifax 1 score.
Yeah, so Equifax 1 score. So, and the history around this is we have Equifax Apply Comprehensive, which was the previous comprehensive score that was in market for quite some time, pretty much since 2014, when comprehensive credit reporting was introduced. And we developed that score off like pilot data. So we had to simulate what comprehensive credit reporting looked like back then, because there wasn't much data around. Fast forward, 8 years later or something like that, when we developed 1 score, we had a lot more data in market, so we could develop a more predictive score, a more accurate score. We used some new, modeling techniques. So traditionally, credit scores haven't used like machine learning, AI, etc. 1 score is our first score in Australia to use some of those techniques to get better outcomes. And the reason why a lender would use 1 score is it's more predictive of risk. So if they're looking at any kind of risk thresholds within the score, they can usually approve more loans, without taking on any more bad debt. So that's why a lender would use it. Why would a broker use it? You just want to make sure you're looking at the same thing.
Absolutely.
Right? So matching up what you're looking at to what the lender's using. All right, moving on to comprehensive credit reporting. So prior to 2014, as we sort of just discussed, in Australia, you were only allowed to collect what's called negative information on a credit file, right? So the obvious one there is, defaults. So that's, if you've got a default, that's really negative or adverse on your file. Also things like bankruptcy information. So if you're bankrupt, that would be showing on your file. But also we've got their credit applications, or you might, see them as credit inquiries on the file. So mostly they would having a negative impact, because what was happening is someone gets, 10 credit, so they want a credit card, they go and apply for 10 credit cards, they've got 10 inquiries on their file, but the lender that's making a decision on their risk doesn't know which ones they have and which ones they don't. So lenders have to assume they have, 10 credit cards, all with 10K limits, for example. So fast forwarding, past 2014, and probably more so in the last 4 or 5 years, where we've got all the CCR data now, lenders now get a much better insight into someone's credit worthiness, because not only do we get negative information, but positive information. So how is someone paying? How did they pay last month? So combining those, it's comprehensive information. And the main things we were allowed to add to the credit report now is date an account was opened and date an account was closed, the type of credit, so is it a home loan, a credit card, a personal loan, etc. The available credit limit. So it's important to know that's the limit, not the balance. Balance isn't included in the credit reporting regime. And then also 24 months of repayment history, which is, a bit of a game changer for lenders in terms of, and assessing whether someone. So before, there wasn't much information on your file, right? Like you would get a few inquiries, a few defaults, and it was hard to sort of know what their credit status looked like. But now you've got this wealth of information. You can see if they're paying month to month. You can make much better decisions, or a lender can make much better decisions. And as a broker, you can, get a lot better view of whether a applicant fits a certain credit profile and should go to a certain lender that you're looking at.
Yeah, I think for us, it was definitely a game changer. We're sharing our information and we utilize CCR. So for us to have the 24 months repayment history information, not having to request all of those statements from the broker to evidence the performance of that debt, and to definitely have a better understanding of how the client's willingness to repay, and seeing that is absolutely, as you said, it's a game changer for us.
Absolutely.
So what could impact the score?
Yeah, so what could impact the score? Remember, now we're in comprehensive. There's things that can both negatively and positively impact that score. So maybe we'll start on the positive. So things like long-term, credit history. So if you've had accounts that haven't, had any missed repayments, etc., then that's obviously a positive. By and large, like a mortgage inquiry is seen as a positive, whereas things like a personal loan or potentially a credit card are probably more seen as a negative. Being able to have a mortgage usually signifies someone's a bit more stable in where they're at in life. Fewer unsecured credit facilities is good. So secured credit is usually better. So even a car loan where it's secured will have more of a positive impact than an unsecured loan. No repayments in arrears, no defaults or judgments, bankruptcies, obviously, things like that. So, conversely, things that negatively impact the score. We talked about having a lot of credit inquiries or frequent credit inquiries within a short term. That still does impact the score, probably less so than pre-comprehensive credit reporting, but it still probably would.
If they're doing frequent applications that are constantly resulting in a decline, though, I'd assume that would impact it worse, like it would increase.
It's probably more just the type of credit they're applying for. And so, it might be that they're going to payday lenders or short-term finances and things like that. They will have a more negative impact on someone's score. So, yeah, we look at things like the frequency of the inquiries, the type of credit. Is it prime? Is it subprime? Is it, payday lending, etc.? So we look at a lot of things in terms of those inquiries. As we said, unsecured credit, even things like instability in residence or employment. So if we do get reported addresses and employment data, if that changes, that can actually negatively impact the score.
So with the residence and employer, does it pick up industry types and does it mitigate that? So obviously you might have somebody who's in a job that is required to be moving constantly. Will it pick up industry types, or it's just a blanket?
It's more if a new employer is reported by a credit provider. So this is all self-reported from a credit provider to us as they're doing an inquiry. So if I make an application for a car today and I work at Equifax, it'll get reported through by that lender as working at Equifax. If I go for a home loan a year later, I'm still with Equifax, and it's the same employer. Whereas if I had changed employers, and maybe that happens 2 or 3 times over a few years, that will start to have a negative impact, because it just shows a bit more instability. And looking at, the statistics across risk, instability of address or employment is a risk factor.
Yeah.
But again, probably less so in the times we're in with comprehensive credit reporting. We're probably more looking at, the repayment history.
The performance of the liability itself.
Exactly.
Yeah. Okay.
Yeah.
Nice.
And lastly, their defaults and judgments and bankruptcies. Any of that really negative information will obviously have a big impact, negative impact. Yeah.
Okay.
So quick report overview. Yes, some of you may or may not have seen an Equifax report. But yeah, I mean, the general structure of a report is, once you submit someone's ID details through, and usually it's name, address, date of birth, or driver's license number is sort of the minimum set of information. We'll then match to a credit file. We'll show you at the top of that report, the identity details you've put in and how long we've had a file on that individual for. You'll then see the score information and some key contributing factors to that score. So whether there's positive impacts on that score or negative impacts on that score. You'll get summary details around, adverse information and bankruptcies, etc. Even ID information that we've matched to. And then you'll get more detailed views of, defaults, judgments, bankruptcies, etc. And then there'll be a whole section around the consumer credit liability information, which is part of comprehensive reporting. So what accounts do they have? What type of account? What's the limit? And then the 24 months repayment history information. So you'll actually get a month-by-month breakdown of how the performance of that account is going. And on one of the subsequent slides, we'll show you what that there's some sort of codes around that. So you'll see a 0, 1, 2, 3, 4, for example. That's how many sort of periods late they are. So 30, 60, 90 days, etc. So yeah, just drawing your attention onto the right there. So on the credit report, if you see 24 months of history and you see a 0 against each one of them, that means they're up to date. They're 0 days late, essentially. If you see a 1 or a 2 or a 3, they're sort of going up to 30, 60, 90 days late. That maxes out with an exit 180 days. And then there are some other codes you may see. So probably most commonly you'll see like a closed. If someone's closed an account, you'll still get the history of that account until that 24 months has run out. So you'll see that often on a report. You might see an R, something's not reported or not associated.
Can we sort of elaborate on that R, so not reported? So when we see that, does that mean that the bank hasn't provided reporting on that liability for that period?
Yeah, essentially. And it's probably not used too often. Like maybe they've had, some issues reporting their data for the month or something like that. So it could be used in that sense. We did see it in COVID when there was COVID payment reliefs. They were allowed to use, either putting R against it or, so it's going back a little bit now, or they had to put the payment status. So if they were already, say, 14 to 29 days late, they'd have to put that status ongoing whilst they're on a payment holiday, etc. So yeah, you will see, and some of that stuff, it's probably all coming off the file now, given where we're sort of at 2025, but you would have seen a little bit of that, back in the COVID days. Otherwise, yeah, it just could be that they haven't been able to get their file to us for whatever reason that month. There was errors in the file or something like that.
Yeah.
Also pending. So if the file's sort of coming through later than we might expect, you may see transferred if something's been like a credit provider has bought a whole portfolio. So they've transferred an account over to another credit provider. So maybe someone sells their credit card portfolio.
Yeah.
So you may see that, but those ones by and large you won't see as much, and you'll just see the kind of the repayment history with the numbering against it showing how late they are.
In terms of, say for example, you've got somebody who's bankrupt, how long will that show on the credit report for? When does it drop off? Because I think there's actually some variances to that depending on how they've acted on the liability.
So bankruptcy is 7 years on the credit file.
Is that it doesn't matter what the situation is, it'll drop off?
Yeah, it will drop off after 7 years off the credit file. However, you could go and run a bankruptcy report with, I think it's AFCA now, it used to be ITSA, so that's the government body. So you could run a bankruptcy report that will go back longer than 7 years and still see if they were bankrupt. But as far as us keeping it on the credit file, it's 7 years. The other thing which you might have been referring to is a default stays on file for 5 years, but if it can get upgraded to what we call a serious credit infringement. So if a credit provider has attempted to collect the money, haven't heard from them, they've moved address, they're getting nowhere, there's some rules they need to meet, but then they could upgrade that to a serious credit infringement, which does stay on for 7 years.
And so in any instance, does the person need to pay up that default for it to drop off, or can it remain unpaid and drop off after 5 years?
Yeah, it would still drop off paid or not paid. So we're only allowed to keep defaults for 5 unless it's serious credit infringement. Then it would be 7, and bankruptcy 7 years. So they're the rules or regulations around what us as a credit bureau is allowed to sort of keep on file. And repayment history is only 2 years, so that's a much shorter term view.
Okay, so some people that are trying to get their money back can go down the path of the serious infringement path.
Yeah.
And so I don't understand why not every creditor would sort of not go down that path, and some of them drop off being unpaid. Obviously, it's maybe costs a bit of money to facilitate that.
I think there's some certain rules that need to be met. Like there's been absolutely no kind of communication back from the debtor. So if there has been communication, it just hasn't been paid for other reasons, then it has to stay as a default. However, if there's no contact coming back at all, that's when it would be upgraded to a serious credit infringement.
Yeah, okay.
Yeah. And I mean, a lot of defaults, maybe they're settled in terms of part payment, different things like that. But when they're a default, the credit provider will use it as a bit of a tool to say, like, we can update it to, paid, or it won't go to a serious credit infringement if you pay, settle this amount, for example.
Yeah, okay. Yeah. Nice. All right.
Yeah. Lastly, so yeah, I think it's important to, yeah, make sure that your clients are educated about their credit report. So one way is through creditsmart.org.au, which is a website. I think it's run by ARCA, the Retail Credit Association, who act on behalf of all the major sort of lenders and institutions. So yeah, it'll give you a lot of information around, getting your report, seeing what's on there. In this example, you can see, credit repair companies and things like that, what to be aware of when dealing with credit repair companies who are promising to, fix your file and remove defaults off your file, etc. But another way you can get your file is through Equifax, or even there's other credit bureaus as well in the market. So you can go direct to the credit bureau to get your file, and you're actually entitled to a credit file every 3 months for free.
Does that leave an inquiry?
It doesn't leave an inquiry. It'll leave the same thing as if a broker accessed it, like a file access, that it has been accessed, but not visible to other lenders. So yeah, you can get your credit report for free. And probably a question often comes in around how an individual can, repair their credit file or increase their credit score. Firstly, get your credit report, see what's on it, see what might be impacting it. If you see anything wrong with it, because there can be errors, it could be fraudulent activity, it could be other things like credit providers reported the wrong information. You can come through to Equifax to get things corrected. And then I think once your credit file is sort of intact, if you still want to have a better score, like there's a little bit of patience, a bit of a waiting game to it, like pay your accounts on time and make sure that, as that bad information drops off after 2 or 5 years, and the good information comes to the surface, if you're paying your accounts on time, it will start to improve. So yeah, just a couple of tips there around supporting your customers to have, the best possible outcome.
I think this is fantastic for, those brokers who dabble in, providing, loans to the underserved Australian market and people that may have been through a life event. This is perfect education to go through with them. So amazing. What I might do, I might just have a look at the Q&A, because there might be some specific questions that are directed towards you, James. So I'll just have a look. Bear with me. Okay, so I've got a client who just paid off their maxed out credit card. How long does it take to show up as closed on Equifax? And does paying it off in full increase his credit score, which currently sits under 600, but comprehensive is over 700?
So how long does it take to show? It usually would show, most lenders will report like monthly, like a monthly file upload. Doesn't necessarily have to be monthly. Some could be more frequent, but mostly it would be monthly. So I'd say to be caught in that monthly file, the next reporting period would see a closed on there. I think if they have any, if they need something corrected earlier, they could approach the lender and maybe see if they can update that to the bureau or bureaus if they're sending it to multiple sooner. It should have, I'm not in the scoring team, so I don't know exactly, but it should start to have a positive impact on the score, because it's a liability that's, potentially had no repayment, bad repayments on it. It's been closed. It's no longer a liability that they've got. But sometimes these things take time to play out too. So as that's been closed for a longer period of time, and depending on some of the other activity on their file, sometimes it could take longer than you may think for that file to improve. So, yeah.
All right, we've got another one here, address risk. So I have noticed some address raise risk flag. What is the explanation of this, and how is it assessed? So particular locations are a risk.
Yeah, so I think this is probably more in our newer one score. Uses some geo risk sort of variables, you might say, usually on a file that has less information on it, like a younger demographic, a newer to bureau file, as we would call it. So in those circumstances, we've built in some geo risk around that. So if someone has moved to a higher risk area based on their address, that can impact, a credit score. It shouldn't be a major impact, but sometimes you may notice it in one score where that score may have changed somewhat due to the location of the individual.
Yeah. So is it possible to request credit repair if we find incorrect information on a credit report? For example, a default listed under a mobile account that the customer was never aware of, possibly opened without their knowledge. So I think you already sort of alluded to this a bit earlier.
Yeah, I would come through to Equifax or whatever credit bureau, that's listed on first. There should be like a correction. We've got Equifax corrections. So a whole team dedicated to updating these sorts of things. That would be my first port of call. I probably wouldn't go to credit repair unless you absolutely have to. And often, often if it is wrong, the bureau can deal with it and update it. Credit repairers, all they'll do is go to a lender and try and sort of catch them out without documentation and things like that to try and get things, taken off. And a lot of the time, they're probably trying to take off things that are valid, defaults and things like that. So yeah, I'd say approach the bureau first. Credit repair is an option, but probably be more
a costly option. Yeah. So I think we've already answered this one, but we'll just do it again just for the group. So what are the options clients have before coming to a broker? Is it once a year for the free reports? I think you've sort of covered.
Yeah, I think it's every 3 months now. By law, a credit bureau has to give that free credit report every 3 months. It can be delayed, so I don't think we have to give it straight away. It's within sort of a 2-week period or something like that. So there are other options too, like
we actually have our Pepper Product Selector tool, which I'll cover off on shortly, we give free Equifax reports as well without leaving an inquiry. So I'll cover that off. But to James's point, there's quite a lot of options out there to
there's subscriptions. You can get a monthly score update directly from Equifax, depending if you want to pay for those services or not, or the end consumer wants to pay for them. But some people are getting more savvy about that. There's Get Credit Score. There's a bunch of other kind of third-party sites that get their score and report, things like that from as well. So,
perfect.
Yeah.
So this is a 2-part question, one which I'll cover off on once we sort of understand what are Pepper Money solutions for clients who may have an impacted credit report. But for you, James, can you discuss financial hardship information and how does it drop off the credit file?
Yeah, so hardship information is one year, so it will drop off after 1 year. And essentially, there's sort of 2 flags on there. There's a permanent variation to a contract or a temporary variation to a contract. So temporary might be just that they've said, you can't pay this month, but you can catch it back up in 3 months' time or something like that. But the contract, stays the same. Whereas a permanent variation, is a whole new restructure of the loan. It kind of starts again. They might need to restructure the repayments and things like that. But that stays on file 1 year, and it doesn't impact any of our credit scores. We're, legally not allowed to have any financial hardship information impact a credit score. So,
So it's up to the lender in terms of how they choose to view that.
Yeah, their risk policies and things like that.
Yeah.
So,
okay. Why are there different types of Equifax reports? Equifax One Score provides different scoring to usual Equifax reports. So we've already covered that one off. Discharge from bankruptcy. Thank you, John. You had the same question as me. So 7 years, it drops off for discharge bankruptcy. Can you please explain again the differences between the Equifax One Score comprehensive score, beta score, and negative data scores, and which one is mainly used or referred to? So I think what we might do is, unless you want to answer all of that again, we might just cover off which one is mainly used or referred to. Just for everybody's benefit, this is recorded, this session. So you will get a recording sent to you within the next couple of days, which then you can refer to and sort of revisit all the information again, if you like. So over to you, James. So which one is typically used?
Yeah, so I mean, it does depend a little bit on the portfolio too. So One Score probably, came out of the block strong on other portfolios other than mortgages, so personal loan, for example. So, and the reason for that is that personal loans, some lenders will just look at a score, look at score cutoffs. Obviously, they've got some other rules, but they heavily rely on the score. So they might say a score between this and this isn't approved, this and this is a refer, and this is a straight decline. And so because One Score is more predictive, like at a bureau score level, regardless of what other risk policies they have, some lenders were utilising that to, fully automate or, mostly automate their decision-making process. So that's probably where the first sweet spot was. As we moved on, more and more major lenders have started to utilise it, but even a lender might utilise it on certain portfolios, but not on others. They might use it on personal loans, but not auto, or they might look at it on mortgages, but not auto, etc. So, it's probably trying to understand that next level of, your lenders on your panel and what they actually, utilise. I mean, the other thing with mortgages, for example, is like a bureau score doesn't mean, like, it's used as a guide, but it doesn't mean that much in the overall context, because you're looking at, can they afford it? You know, once you get their income information and all of their other liabilities and the mortgage repayments and things like that, that's probably more important than a bureau score in a mortgage kind of sense. So yeah, there's some of the other factors you'd probably look at there. But mortgage lenders would still use it in some capacity to look at just a quick sort of overview of the quality of that applicant. So, yeah.
So just for everybody on the webinar today, we use the Equifax 1 score. So we've got here, will the report show when bankruptcy is discharged? And is part 9 and 10, or what's part 9 and what's a part 10? Debt agreement in comparison to bankruptcy. Can you tell us the differences between those three?
I'd probably defer that one. I'll get some more information from our product team on that.
Yes.
It's just probably a level of detail I don't often go to. So yeah, we can take that one away and just get some information back for you.
Perfect.
But we do get questions from our clients on these sorts of things, but yeah, not always at the top of my mind in terms of that level of detail.
That's okay. So what we'll do for that particular question, it is anonymous, but I'm sure everybody's keen to understand that, as am I, actually. So we'll get the information, and then what we'll do is we'll pop it in our post-webinar email, where you'll have the recording to the webinar, and then I can pop that question and answer in there as well for everybody. So I've got here, if a client pays an amount in full and final settlement of a debt and the lender writes off the balance, does that affect their score, or is that up to the lender?
So client pays out the amount in full, final settlement of the debt. It probably depends on what, is the lender a comprehensive reporting customer or a negative reporting customer? If negative and they've lodged a default on the file, then there's going to be some lasting impact for 5 years, for example. If it's comprehensive and maybe it's not at the point of a default, but there's still late repayments, up to maybe 60 days reported. That one can probably vary a bit, but it probably depends on what has been put on the file in the first place. Is it a default? If yes, it's 5 years. If it's just repayment history information, like a negative repayment history, 2 years. So yeah, but usually there is a time period where that report needs to kind of repair over time and improve over time based on that information dropping off.
And if they're even sharing information to begin with.
Yeah, exactly. Yeah.
So we did have just a follow-on question regarding the serious credit infringements.
Yeah.
So will it show for 7 years in total from the original credit infringement, not another 7 years after the default has already been shown for 5 years?
No, I think it's from that.
From the original?
Yeah.
So even though if it's gone to serious credit infringement, it would still be within that 5-year period if it's a default.
Exactly.
Yeah. Perfect. Okay, sorry, the questions are moving around, just bear with me. I'm getting a lot of questions for you here, James, which is good.
It is a hot topic.
It is a hot topic. Okay, if a client inquires, say, for a pre-approval direct through a branch that runs an Equifax, does the act itself reduce their credit score? So I guess it just depends on how they run that. If they're doing an access seeker report or an Equifax, or they're doing a hard inquiry. Typically, you'd find, if some lenders choose to do a soft approval, which means they don't actually do a proper credit assessment. For us, if you were going to request a pre-approval, it would be fully credit assessed, which means we are going to access, we'll leave an inquiry on the credit report because we want to be able to assess the client, basically. So some lenders do and some lenders don't. I guess it just depends on what their process is.
So yeah, probably to elaborate as well. So brokers can, do this soft inquiry under the access seeker provision that we talked about. Lenders also can do a soft inquiry through a bit of a different mechanism. So we've got a product in market used to be called Score Seeker, sort of rebranded it Pre-Qualify now. But so that would allow, as long as there's a credit application being made by the individual to a lender, the lender can actually usually get their score at least at the, upfront in the application, and only leave that soft inquiry and then give them an offer of some sort. So you're likely to be approved, or your rate is likely X. And so that will encourage them to go through and apply for the full product. So bear in mind, this is direct, not through brokers. And then should they then fully apply, then that lender is obliged under our, terms and conditions for using that product to do the hard inquiry. So more of that is happening in market. Some other lenders have actually gone down the route of creating a separate entity within their group that is not a lender, and that different entity will use an access seeker report because they're deemed to be an access seeker, and then they'll sort of send that deal through to their lending entity. That is getting like a bit more scrutiny. The Privacy Commissioner, ARCA, the retail credit body, kind of looking at that a bit more. There's also like a review of soft inquiries in the industry and how lenders can use them in a more uniform way. So you'll probably see more in the next sort of 12 to 18 months around, like a framework for lenders to be able to use those sort of products so that it's not, this mishmash of different ways of doing it.
Yeah. Okay. What have we got here? Let's have a look. So you mentioned previously lots of credit card applications is really impacting. What about nowadays? Clients chase obviously frequent flyer points. So constantly apply for new credit cards and closing every 6 months. Also to apply for the next one. Obviously, I would assume that this one that does kind of have an impact because it's an unsecured
probably still would,
liability.
But I think, obviously I'm not, a scoring analyst, but I would think it would be less impactful than in the past because comprehensive credit reporting will tell us whether that inquiry turned into an account, and then if they close that account, we can see that it's closed. So probably would have penalised you a lot more in the negative reporting regime than it does under the comprehensive reporting regime. But overall inquiries still do matter to a degree in our scores. So it could still have somewhat of a negative impact, but hopefully not as much.
So we've got here, could you explain the use of the term hardship and how it impacts your credit scores? So the term hardship really is around the client seeking assistance because they're unable to pay their debt due to, we'd hope it's a life event, and how it impacts your credit score. So
yes, it doesn't impact your credit score, not allowed to. In terms of, it really is between the individual and the lender. So essentially as a bureau, we're just told how we have to record it. So if a lender, it basically is in the CCR kind of data requirements that a lender has to submit through to a bureau. If someone's approached them for hardship and they've gone through the process and deemed they're in hardship, then they need to decide whether it's a temporary or a permanent variation, and then have to report it to a bureau in a certain way. So, and we're not allowed to impact the credit score.
Okay.
So that's the summary.
That's a good one. So will financial hardship still show on the file after they close accounts? I think James said earlier it shows for 12 months. Is that correct?
Yeah.
Even after they've closed the facility? Yeah,
it would. And the repayment history would also stay on for 12 months. Sorry, for 2 years.
2 years. Yeah. Okay, I'm just going through these questions. Bear with me. We're getting lots of questions here. Does director penalty notice show on a credit report?
I'm not sure.
And that's more around non-consumer.
I don't think so, but
okay.
I'm not exactly sure what it is, so I'd have to look up that one.
Sorry, guys, I'm just reading through, just trying to find questions that haven't been answered. Okay, so a lot of these questions here that I can see now are general questions that have been answered already, but if they haven't, what we'll do is James and I, after this session, we actually get a copy of the Q&A report. So if there's any additional questions that haven't been responded to that aren't in the recording already, then what we'll do is we'll go through those. We'll put together a bit of a Q&A, and then we can also pop that in the post webinar email that's going to come out to you in a couple of days with everything you need to know about comprehensive credit reporting, including that reporting. So we'll add a Q&A into that as well for you guys, because I can see with the amount of time that we have left, the questions keep building, and we don't want to keep you for longer than the hour, which we want to promise that we stayed at 60 minutes. But what we may do as well, because as James alluded to, he covers the consumer side of things. So obviously we offer commercial and SMSF as well. So there is a question within the survey around additional topics that you'd like to see from us. So if understanding somebody from Equifax in that commercial and SMSF space, if you'd like to learn more as well, please pop that on the survey, because then we can organise that with James and get that sorted for you. So we'll move on for now, and we will cover off on how Pepper Money can assist all of these clients that you guys are obviously seeing that have impacted credit reports due to life events. So as you can see here, we have so many options across our cascading credit model that assist with clients who may have an impacted credit report. So in terms of your type of credit impairment, you can see here in the prime product, we are really only looking at clients who have that clean credit report. However, we can assist clients who have a paid default up to $500, and that's typically non-financial as well. So clients that may have a telco default or something on their credit report. In terms of the prime product as well, we are really looking at those personal purposes. However, we can look at paying out private debts in the prime product as well. And we have recently changed our credit policy in prime to pay out unlimited debt consolidation as well. In that near prime clear product, the second product along, which is the second green one there, you can see we start to dabble a little bit into those solutions for clients who need that outside of box solution. So in terms of late repayments, we can do up to 1 month non-mortgage arrears within the last 3 months. Now, as long as they don't exceed a 1, we can assist. So you might have a client. We always see this. You've got your high net worth client who's got a few credit cards, and they're not really good at managing those credit cards. And so you may constantly see those 1s every month because they've made the repayment, but they've missed the repayment and then they've made it up again. And then they've missed the repayment, they've made it up again, but they haven't crept past 29 days in arrears. So they haven't sort of gone to that 2. So if it's just got 1 in the last 3 months, then we can accept them in that near prime clear product. We can also pay out tax debt in that near prime clear product, and again, pay out those private debts. In terms of defaults, we can accept an unlimited amount of defaults, whether they're paid or unpaid, up to $1,000. So your client could have 10 $1,000 defaults, for example. As long as they haven't gone over that $1,000 mark, near prime clear is the product for them, and that has a very competitive interest rate for looking at clients for personal and business needs, private debt, tax debt, and a little bit of that impacted credit report there as well. Then we move into that near prime product, and this is where we start to assist clients who have been through a major life event roughly 2 years ago. So in terms of late repayments, again, we can look at non-mortgage arrears up to 3 months worth. So you could see a 1, a 2, or a 3 in late payments within the last 3 months reporting period. So it's really good to understand that with us, when we're looking at non-mortgages, in terms of the liabilities you'll see on that comprehensive credit report, we only look at the last 3 months history for late repayments. Even though we can see the last 24 months history, we're only looking at 3 months. In terms of defaults, we can look at unlimited defaults, court judgments and writs up to $3,000. So paid or unpaid, they could have 10 $3,000 defaults, paid or unpaid, registered at any given time frame, and we'll accept them in this product. If they're over $3,000 individually, that's when we sort of deem it as a major life event, and we'd like to see them not default again for at least 2 years. That shows us that they're on their way, they've got their life back in order, they're stable again, and they're on that prime trajectory. So if it's over $3,000, then it has to be registered on that credit report for at least 24 months for it to sit into that near prime product. Again, though, it doesn't need to be paid. It can remain unpaid with us. In terms of bankruptcy, I love this niche, 1 day discharged. So that also correlates with, say, for example, you've got a client who still has an outstanding debt that needs to be paid off to become discharged. We can facilitate that with an equity release. So if they have a mortgage already and they've got some equity in that property and they want to refinance it to us, and they want to pay out that facility, which means the bankruptcy will then become discharged and we get that confirmation, we can absolutely facilitate that solution as well. Mortgage arrears, we still aren't looking at mortgage arrears in that prime, near prime clear or near prime products. But again, we do look after tax debt payouts and also private debt in that near prime product. Now, your specialist and specialist plus is where we can provide solutions with somebody who has mortgage arrears or who have been through a major life event within the last 2 years and also within the last 12 months. So the specialist product here, we can look at late repayments up to 6 months for non-mortgage arrears. And for mortgage arrears, we can look after somebody that has mortgage arrears up to 1 month. So if they're 14 to 29 days overdue on that repayment and we're seeing a 1 on that credit report, then we can facilitate a solution on that specialist product. Now, it's really important to note, as I mentioned earlier, where we only look at the last 3 months reporting information for non-mortgages. When we're looking at mortgages, even though we can see the last 24 months, if we are looking at refinancing somebody from a non-bank to us, we will look at the last 12 months reporting information on the conduct on that mortgage. If you've got somebody that's coming over to us from a major bank or not a non-bank, then we're looking at the most recent 6 months reporting. So as mentioned, even though we can see the last 24 months, we look at the last 6 months only for major bank and 12 months for non-bank. Now, in terms of defaults and how we treat them in that specialist product, same rule applies. If they're less than $3,000, then we can have an unlimited amount, whether they're paid or unpaid. If they're over $3,000, then rather than them being listed for 24 months, we'll accept them for just being listed for 12 months. So obviously we're taking on a bit more risk. That client has been out of the woods for 12 months. But as you can see, the risk kind of drops substantially when they've had a stable history for 2 years. In terms of discharge from bankruptcy, it's the same. So 1 day discharged as well. And then in the specialist plus, very similar to the specialist product, once again, though, we just allow for a client who is pretty much going through a life event or who has just come out of a life event. So if we're looking at defaults, if they're over $3,000, they can be registered at any given time frame. So they could have had a default for $4,000 registered yesterday, paid or unpaid. We'll be able to look at them, be able to provide them a solution, that specialist plus product. When it comes to mortgage arrears, unlimited mortgage arrears within the last 6 months as well. So you could have 1 all the way through to an X on that credit report within that last 6 or 12 months reporting window. And then obviously with the discharge from bankruptcy, we're still looking at that 1 day. So as you can see, across that cascading credit model on all 5 products, we have a very comprehensive and robust solution that can assist clients at any time of their life. We do know that 1 in every 3 Australian actually does need a real life solution within their lifetime because they go through a life event. So lots of solutions here. If you did want more training on our outside of box solutions, absolutely you can note that in the survey that's going to come out after today's session. Real life for commercial and SMSF. So again, we have that cascading credit model for commercial and SMSF. However, we don't have a solution for that specialist type of client. So if you've got a client who has had mortgage arrears, then unfortunately we won't be able to assist with our commercial and SMSF. There are some slight variances with that near prime product as well in terms of default treatment. So the late repayments are the same, so up to 3 months on non-mortgages within the last 3 months, but defaults, we're looking at defaults that are over $1,000 need to be registered for 24 months. Again, though, it doesn't matter if they're paid or unpaid. Also, the discharge from bankruptcy, they have to be discharged for longer than 24 months in our commercial and SMSF offerings as well. Okay, so something that's really important to note when you have got a client who you would like to bring to us that may have been through a life event which has impacted their ability to pay their mortgage, we will conduct a capacity to repay test if there is more than a 1 or higher than a 1 on that comprehensive credit report under the mortgage within that last 6 to 12 month reporting window. So if you've got 2s and above for mortgage arrears, then we will conduct a capacity test. And basically, a capacity test is to make sure that we aren't putting the client into a worse financial situation. Our objective is obviously to help that client get back on track and put them into a better position so they can start getting better interest rates and allow them to be able to afford their loan. So what we will do is there's an example here in front of you where you've got a client who has a mortgage with Me Bank, and then they've got 3 other liabilities there, one with Subaru, a credit card and a Gem Visa. And you can see the amounts that they have owing and their minimum monthly repayments. And then we can see in month 1, month 2, and month 3, what the client had the ability to actually repay. So they've not met those minimum monthly installments, but they have met part of those installments. And as you can see down below, you've got the new loan amount, the rate, the years, and what that repayment is on a monthly basis. And if we add up what the client has repaid over those most recent 3 months, and we look at that average repayment, we can see that the client has had the ability to pay more than our new monthly contracted repayment, which tells us that even though the client couldn't afford to pay the full liabilities, they have demonstrated that they have had the ability to pay more than our new repayment, which means hopefully they're not going to get into trouble in future, but we know that we've done our due diligence to make sure we're not putting them in a worse financial situation by providing a higher repayment than what they're currently managing to pay at the moment. So just know that we will complete a capacity to repay if your client has mortgage arrears and they have greater than a 1 on that comprehensive credit report. So really quickly, we do have a Pepper Product Selector tool that's available on the broker portal. You do need to log in. This is the only time you need to log into the portal to utilize this, and that is simply because we do provide that free Access Seeker report for you to be able to utilize with your conversations and your clients. It is free of charge. It takes roughly 3 to 4 minutes to complete the product selector. It does ask a simple set of questions. I think there's roughly 13 questions. It does give you the Access Seeker credit report without leaving an inquiry. It's a soft touch. And what it'll also give you is the product, rate, fees. And I think most importantly, it obviously gives you that credit report, so you can have a look at what's going on in that report to have a look at how your client has performed on those liabilities that they have, and if there are any defaults that you should be made aware of. And it also gives you that monthly repayment. And what that enables you to do is have a robust conversation with the client around whether the loan and the solution that you have provided is affordable and within their ability to repay as well. So just lastly, we've got a quick scenario here. This is Kate, and she's looking to purchase a bigger vehicle to help transport her mum to her doctor's appointments. So she'd like to consolidate her 2 credit cards into her mortgage and use cash out to fund the car purchase. Kate has always paid her mortgage on time, but after taking extended time off work to look after her sick mum, she fell into 2 months of arrears. Because of these mortgage arrears, Kate's bank said no to consolidating her credit cards and getting the cash out that she needs to purchase that bigger vehicle for her mum. So after confirming with Kate's employer that she is back at work full-time and Kate successfully passing our capacity test, she qualifies for our Specialist Plus option. So through this option, we were able to consolidate her credit cards and assist with the cash out for the new car purchase. If Kate makes her new mortgage repayments on time and maintains clear credit conduct with no new credit impairments, she could qualify for the prime option after just 6 short months, allowing her to get back to a prime rate and a prime position. So again, unlike a lot of major banks for us, if we have that 6 months good repayment history, even if they're coming from a non-bank to us, we will only require them to maintain good conduct with us for 6 months before you could rewrite the loan with us and move that into that prime product, pending obviously they meet all the other policies that surround the prime product. But in terms of those the repayment history and the mortgage arrears, it's just 6 months, which is a great outcome or a great succession plan for your client as well. So that's it for today's session. I know we've got quite a number of more questions that have come through that chat. Just know that we will come back to you. And please, 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 if you could answer all of the questions on the survey that's going to come out to you shortly. And thank you so much, James.
Thanks for having me.
I don't think I've talked so much in a webinar. It's great. We've had lots of engagement. Yeah, the full hour, which is awesome. So I look forward to seeing you all on the next webinar series to provide you some more education. Thank you. Bye-bye.
All right.